Okay, so in this chapter, we will learn how to evaluate a single project alternative. And the idea is this. Assume you have a project, a business idea, and you estimated all the costs and revenues of this project, and you came up with the cash flow for this project. And the question is this: will you invest in this project or not? Is it beneficial for you to invest in this project or not? How can we evaluate this? In this chapter, we will learn how to evaluate such single projects. So, in all engineering economy studies of these capital projects, we should consider the return that this project will produce. I mean, why are we investing in a project? If it's a private company, you want to make profit, right? If it's a governmental agency, governmental project, then you want to satisfy a service requirement, maybe for your citizens, but you want to do it in the minimum possible cost. We will talk about this later on. But now our aim is to consider such private companies so that we want to make profit. And in order to make this profit, is this project alternative beneficial or not? So in this chapter, we will learn this return and worth of revenues. We will calculate these to decide whether a project is successful or not. So that we can compare this project with alternatives with respect to their worth. When I say worth, it's present worth, future worth, or annual worth. We can compare their worth of their revenues and then decide on the alternatives, or decide whether this project alternative is beneficial or not. So what's our objective in this chapter? It is to evaluate the economic profitability and liquidity of a single proposed problem solution. So when I say liquidity, liquidity means how quickly you will convert your assets into money, and how quickly you will get the return from your investment. Okay, so we will learn some measures for project's probability. We will learn the present worth method, future worth method, annual worth method. We will learn internal rate of return and external rate of return methods. In terms of the measures for liquidity, we will learn simple payback method, discounted payback method, and we can have a look at the investment balance. In order to measure the project's profitability as an worth method, present, future, or annual worth, remember in the previous chapter, in our calculations to find the present value, we used the interest rate. We denoted it as I. It was the interest rate. Okay? But now the idea is this. There is a project, there is a business project, and in this business project, you assume that initially you will have such a capital investment. Then starting from year one, you will start earning some money. Okay? And you have this estimated cash flow. And now you have this cash flow diagram. And for this cash flow diagram, you want to find its present worth or annual worth. Then what is the interest rate here? What interest rate should you use? This is a project alternative. You are not depositing this money into a bank account and earning this. You are, for example, buying some new machines, equipment, and etc. to start your business. And after some time, you will start earning this money. And then you want to learn what is the present worth of this cash flow. So what is the interest rate in this case? So for this, in order to answer this question, we need to learn a concept called minimum attractive rate of return, or MARR. I will shortly name this as MARR, okay, MARR, minimum attractive rate of return. What does it mean? This MARR is the minimum attractive rate of return. The name should define it. Okay, the name defines it very good. It is the minimal attractive rate of return that is acceptable for a project, and this MARR depends on the risks associated with the project. The market for capital, can you find the initial investment amount from banks or other institutions quickly and easily, and what is that interest rate, and etc. And also the opportunity cost of the owner. What does it mean? If you don't invest this money in this project alternative, what is the next best alternative? What can you do with your money? Can you earn more? For example, instead of investing your money, let's say you have $10,000, and with this $10,000 you can invest it in your project idea and you will have some earnings. But if instead of investing in this project, if you deposited this $10,000 into a bank account, that bank will provide you 5% or 10% interest rate. So you will earn that 5 or 6% interest rate from the bank. This is a next best alternative. And if your project will not return more than this rate, if it returns, for example, 2%, if it is 3%, you will not want to invest in this. Why? Because there's already another alternative that you will earn more. So I'm not saying that you are losing money. You are still earning, but you are earning money less than the next best alternative. And this MARR represents the interest rate of the next best alternative, the rate of return for the next best alternative. And also it will include some margin for risks and for the capitals. This MARR will be higher for riskier project. If a project is risky, what does it mean risky? So you calculate it, since we are talking about future, in a project you can estimate the future, let's say, revenues, and you can estimate that, okay, you will earn 8%. But also, this is the average that you can earn. In the best case, in the opportunistic cases, if everything goes smooth and well, maybe you will earn 12%. But in the worst case, maybe you will lose your money, -1%. You will lose the amount. So this, you can think about this as a risky project, because yes, on the average you are earning 8%, but there is a high risk of losing your money, or there is a high risk of earning less than this one. And if the project is risky, then you usually set your minimum attractive rate of return, or MARR, to a higher value. Or if the rising interest rates, the rising of interest rates will increase the MARR. If the bank interests and etc. are at a higher level, then your minimum attractive rate of return will also be higher. If there is a higher number of attractive competing projects, then again the MARR value will be higher. Okay, so what is this MARR? MARR. It is the interest rate that we will use in cash flow calculations, and this MARR, this MARR, is the minimum rate of return that will make you to invest in this project. If your return from this project is less than MARR, you will not want to invest in that. If it is greater than MARR, you want to invest in this project. Okay? MARR has such a meaning, and it is one of the important concepts of this chapter and of this topic. Okay, so continuing on MARR, MARR is an interest rate. Okay, so when I tell what's MARR, MARR is the interest rate that you will use in your calculations. And it is an interest rate used to convert the cash flows of the project into equivalent worth, present, future, annual, equivalent worth at some point in time. Usually, this MARR, in order to determine this MARR, it's based on the availability of funds for investment. Usually, how do you obtain the funds? You borrow loan from the banks, for example. This is the easiest one. And if you borrow these funds from the bank, it means that your rate of return on this project should be at least equal to the amount of the interest rate of the bank. Otherwise, it means that you are borrowing from the bank with an interest rate, let's say, of 6%, but from the project you are earning a money of 3%. So actually, you need to pay this money back to the bank with 6% interest rate. It means that you are losing money. Okay, so the MARR, the MARR, depends on the availability of the funds. The number of good projects available for investment. So this is your current project alternative, and you are thinking, should I invest in this one or not? And there are other alternatives, alternative 1, 2, 3, a lot of such alternatives. And if you already estimated the rate of returns of these projects to be higher than this one, or let's say you found that this project may have a return for 6%, this project may have 8%, this project 1%, this project 10%, and etc. So what would be the MARR that will attract you to this project? That's why we are saying it's minimal attractive rate of return. So there should be an interest rate so that you will be attracted to this project. And that interest rate should be larger than the maximum of the other projects. Okay, which is, for example, 10%. If there are more project alternatives, then there's a good chance that one of them will have a higher rate of return, so that the MARR value that you need to consider for the current project will also be higher. Also, MARR should include some margin for the risk. If a project is risky, you want to earn a higher rate of return. Otherwise, you will not take that risk, because there is a good opportunity, or that there's a good possibility that you will lose your money. And also, this MARR depends on the type of the organization involved, whether it's a governmental organization, it's a public company, or a private company. So the objective of the private company is to make money, so that they may look for higher MARR values. But the government is not for making money. Government wants to provide service to its citizens, but of course it wants to do it in the least costly way. Okay, so the point of view, whether it's private or government, changes the thing. So MARR is sometimes referred to as the hurdle rate. Okay, it's also referred to as the hurdle rate. So MARR exists when the management decides to restrict the total amount of capital invested by desire or by a limit of available capital. Okay, the management of the company, or if it's your company, you decide to restrict the total amount of invested capital. If you want to restrict this either by your will or by the availability of the capital, then this MARR exists. A project is profitable. We say that a project is profitable if it generates a sufficient amount of cash flow to pay back the initial investment. Usually, when we are talking about projects, we are talking about such a cash flow. We have an initial investment amount, so you need to buy land, building, equipment, machinery, and etc. And for all these, you need capital investment. This is the initial lump sum amount that you need to pay for your business. And in the following years, you will earn money, maybe at an increasing rate or fluctuating from one year to another. So a regular or a standard cash flow for a business should be like this. Okay? So a project, we say, is profitable if it generates this cash flow to pay back this initial amount and then earn an interest rate that is greater than or equal to this MARR. Okay? So if your earning from this project is greater than your minimum attractive rate of return, then we say that project is profitable. Otherwise, we assume that the project is not profitable. We are not saying that you are losing money. Maybe you are not losing money. You may be still earning money, but you are earning less than the next best alternative. Okay, you should think in this way. There's another alternative, and that alternative earns more than this one. So why are you investing in this project in that case? Also, for the companies, usually from one year to another, from time, the amount of investment capital and the opportunities, available opportunities, change over time. So it means that the firm's MARR value usually is not constant. It changes over time. Okay? But still, when you are doing an analysis now, you need to consider, together with the costs and revenues for the future periods, you also need to estimate maybe the MARR value for the upcoming years, and you need to use this in your analysis. Okay, now we learned the concept of MARR, minimum attractive rate of return. Okay, it is the interest rate. It is the earning rate of the project, and that earning rate attracts you to this project, into this project. This is the idea. Now, we will start learning the first method to evaluate a single project. So, there is a project alternative, there is a business alternative, it has a cash flow, and you want to identify if this project is beneficial, is profitable or not, so that at the end we will make a decision whether to invest in this project or not. Okay, so we will use equivalent word analysis, whether it's present word, future word, annual word. In the first case, we will do this present word. I mean, we will evaluate this project finding the present worth of its cash flow. And when doing this analysis, when finding its present worth, we will use this MARR as the interest rate in the calculations. Okay? So this present worth measures how much money can be afforded for investment in excess of cost. The idea here will be this. So what we are going to do, we have such a business, we have initial investment and earnings, we find the present worth of all these earnings using MARR as the interest rate. This is already at time 0, and we will find the net value at time 0. And if this net value is greater than 0, if it is positive, we will accept this project. And what does it mean? It means that when this is greater than or equal to 0, it means that this project earns more than the MARR, more than the minimum attractive rate of return. Otherwise, if present worth is less than 0, it means that you are not, it doesn't mean that you are losing money. It means that you are earning less than MARR. Of course, you may be losing, but we don't know if you are losing or not. But for definitely, we know that you are earning less than the minimum attractive rate of return. How do we do the present worth analysis? Actually, it is very simple. For your cash flow, let's assume that you have this cash flow. This is the initial investment. Let me say I, the initial investment. And then in your future times, you have these cash flows. This is F1, F2, F3, F4, F5 for 5 years. Assume that this project will continue for 5 years. Okay, and your MARR is given as 6%. Now, how do we do, just a minute, how do we do this present worth analysis? We simply calculate this present worth, okay, P. And what do? We convert this future value into time 0, this second one into time 0, third one, fourth one, all of them into time 0. Of course, if there is a uniform payment series, you can use that formula. So everything we calculate, we compute at time 0, and then look at this present worth. If this present worth is greater than 0, accept it. Otherwise, if it is less than 0, reject it. If it is exactly equal to 0, then it means that you are indifferent. If you invest in this project, or if you invest in the alternative project, you will make exactly the same income. And don't be confused with this formula over here. It is not a formula, actually. This one over here. It is not a formula. It is how you find the present worth of all of these. In order to find the present worth of this F1, what do? You multiply F1 by 1 plus 0.06, which is the MARR, to the power minus 1. For F2, you multiply it by 0.06 to the minus 2. And for F5, you multiply it to the power minus 5. And this calculation is exactly this calculation over here. So it is not a formula. You don't need to memorize anything. Okay? As I told you, this is not a formula that you need to memorize. It is just finding the present worth of the cash flow diagram by using the formulas that we already learned in the previous lectures. Okay, so what is our principle in doing this net present worth analysis? The principle is to compute the equivalent net surplus. Surplus means the profits minus, the income minus the expenditures at N0 for a given interest rate I, which is the MARR. This interest rate will be MARR. Okay. Decision rule. What is the decision rule for evaluating this project? We will accept the project if this net surplus is positive. Okay. If later on we will start comparing multiple alternatives in the following chapters. If we compare multiple alternatives using net present worth measure, we will select the project alternative with the largest net present worth. Actually, it is very simple idea. If you have such a cash flow, in now and at the end of year 1 you have some spendings, and then you will start earning some money. This is the inflow and this is the outflow. You find the present value of the inflow using MARR as the interest rate. You find the present value of the outflow again using MARR, and then you will find the net inflow minus outflow, and then you will compare this value whether it is greater than 0 or not. If it is greater than 0, you will accept it. Otherwise, you will reject this project. This is how we implement present worth method. And the thing is, in present worth, depending on the interest rate and depending on the number of years into the future, your present worth of a cash flow can be changed. So how does it change? When the interest rate is higher or the cash flow appears further into the future, then its present worth is lower. So let's try to see this in this graph. Okay, so let's assume that if 1000 cash flow occurs at a future time. If this future time is, let's say, time 1, we can say end of year 1. And let's say we have 1000 and we want to find its present worth now. Okay, and let's assume that this interest rate is 5%. So how do we find this present worth? We simply convert this 1000 into future using this interest rate. And look, when year is 1 and when the interest rate is 5, then your present worth should be something like this. This graph shows it. Okay, but if the interest rate is not 5%, but if it is 10% and you find it is present worth, then the present worth will be something like this. So compare these two. When the interest rate is lower, you have a higher present worth. When the interest rate is higher, you have a lower present worth. This shows when the interest rate is 0. If the interest rate is 0, your original amount 1000 is conserved for all the time. Continue increasing the interest rate. When the interest rate is 20%, so your present worth will be this much. And when the interest rate is, let's say, how much? 30%, then your present worth will be this much. So this shows that as the interest rate increases, the present worth decreases. Now let's consider, depending on time, what happens. If instead of year 1, if your cash flow occurs in year 2, 1000 of cash flow. So instead of having this 1000 in year 1, if you have in year 2 with 5% interest rate, what happens? Look, this is the present worth at the end of year 1, and this is the present worth at the end of year 2 for 5% interest rate. And as you can see, when we go into the future, the present worth decreases. So this is an observation. As we increase the interest rate, as we have a higher MARR value, and as these cash flows occur in future in time, then the present worth is lower. Okay, this is an observation. I will just solve this example to show you the present worth method, and we will end at this point. It says that a piece of new equipment has been proposed by engineers to increase the productivity of a certain manual welding operation. The investment cost is $25. Okay, when we say investment, we will assume that it's occurring now if the time is not indicated. And the equipment will have a market value of 5,000 at the end of a study period of 5 years. Look, this is important. So the market value of 5,000 at the end of 5 years means that you can sell this equipment in the market and earn an amount of 5,000 by selling it. So at the beginning of the project, we are buying this equipment. At the end of the project, we are reselling it. And initially, we are paying this amount to buy the equipment. And at the end, we are earning this amount after selling that equipment. And it says that increased productivity attributable to the equipment will amount 8,000 per year after extra operating costs have been subtracted from the revenue generated by the additional production. So what does it say? This is the story, but it says that each year net earning of this project will be $8,000. That's it. A cash flow diagram for this is given. Okay, it's not given. I am going to sketch it. And if the firm's MARR is 20, look, the firm's MARR is given, and it is given as 20%. And we are asked, is this proposal a sound one? Use the present worth method. Should we invest in this project or not? The idea is this. And let me sketch the cash flow diagram. So initially at time 0, we have a spending, an initial investment of $25,000. Then at the end of each year, for 5 years, the project lifetime is 5 years. It says that at the end of each year, we have $8,000 of net profit after subtracting the cost. And at the end of the 5th year, when I sell this in the market, I have an additional $5,000. Okay, and this is the cash flow, and the MARR is given to us as 20%. So what shall we do? We will find the cash inflow, the present worth of the cash inflow. This is already the present worth of the cash outflow, and we will subtract this outflow from the inflow. So the present worth with 20% MARR, so sometimes we represent it like this. Present worth using 20% of MARR is equal to, how can I find the present worth of the cash inflow? This 8,000 is a uniform payment series. So P given A, 20% and 5. And what about this final 5,000? I need to find its present worth. So plus 5,000 P given F this time, and it is 20% again and 5. So these are the cash inflow, and from this one I need to subtract 25,000. So after calculating this, I will see if this number, if this value is greater than 0 or not. So let me show. So this is the calculation: 8,000 P given A, 5,000 P given F, minus 25, and this value is positive 934 dollars. This is positive, and we check if it is greater than or equal to 0. And yes, it is greater than or equal to 0. So it means that you are earning. How much you are earning? Are you earning $934? No. This is the excess amount over your MARR. You are earning more than your MARR value. You are earning more than 20% in this project. Okay, so it's very important to understand this fact. If this value was, for example, minus $100, are you losing money? No, we cannot say if you are losing or not. But we can say that maybe you are earning 18%, which is less than your MARR, which is 20%. So if this number is negative, you may be still earning, but earning at a lower rate than your MARR. Okay? So I will stop at this point. This is the end of this lecture. So this we will continue learning these or evaluating single project alternatives in the following lectures.